Very interesting day today because we've had the latest non-farm payroll numbers, the latest US jobs data, and it presents a pretty mixed picture for February. We've seen 275,000 jobs added in the month. That is above expectations, but unemployment is up as well, and wage inflation is down. So difficult for the markets to really make a strong assessment with those mixed figures.
It's really interesting here today, Johnny, because a lot of people were looking towards this number with a lot of anticipation. Because if you've kept up with the stock market, it's just been a straight shot upwards. And what that tells you is that there's a lot of high expectations for the jobs market to kind of hang in there while inflation continues to come down, and we're going to see rate cuts. And there's this perfect, kind of fairy tale story that's been set up by the market. Now it could happen, so I should revise my phrase of fairy tale story. Like, it could happen. But here's the thing. Today, we saw jobs numbers came out higher than expected, 275,000 jobs compared to the forecast of 198K approximately. Here's where things get messy though. The market is now selling off here this morning, at least where I am. It's afternoon there. But in what we're seeing here today, we're seeing the NASDAQ and the S&P 500 at the time of recording. They jumped up initially, but have given back a lot of their gains here today. The big thing I would point here is that, as you mentioned, unemployment rate ticked higher, but the devil's in the details here, because what really caught markets, I think, by surprise is that last month's number, that 353,000 jobs that were created, which was a blockbuster news. Everybody was so excited about strong jobs are going to be, strong jobs while inflation's cooling. This is great news. Well, what we got in today's number in the revisions category for last month's report was we went from 353,000 jobs down to 229,000. They revised it much lower by near 120,000 jobs. That is a substantial jobs kind of revision. So one thing to think about here is that, yes, you had a beat on this report, but we had a huge revision down from the last one. So the market initially saw a little bit of a rip higher. Hey, jobs are going to be okay. But what we're seeing here is you combine that with, as you mentioned, the average hourly earnings, which came out cooler than expected. Wage growth being cool, jobs numbers overall being cool when you take into consideration revisions, and unemployment rate ticking higher. This, to me, Johnny, what's interesting here is it kind of suggests that maybe Fed rate cuts, those probabilities are increasing, not necessarily just because, hey, the Fed can get away with cutting rates and this is that perfect story, but maybe there's an increased probability that we need to see rate cuts. Maybe there's a little bit of a lot of slowing down going on, and that's challenging that perfect outcome scenario. We're seeing jobs slide. We're seeing, people struggle with their, the cost of living crisis. There's a lot of stuff piling up here to just say that it's just a perfect story. So this jobs data today definitely caused some concern. You also saw certain key areas of the market like gold continue to press higher here on this. Oil is selling off. Perhaps that's a little bit of the demand side getting cut due to again, slowing jobs in the U.S., less demand for oil. So you got a couple things here coming into play.
I'm interested in this revised jobs number, Nick. As you said, 120,000 lower than we thought. Now, that is a big number. That's around about a third of the total increase in jobs last month that we originally had. It's a very important figure, non-farm payroll. It dictates a lot of minds in terms of what we're going to do with interest rate cuts and how the economy is doing and so on. How can it be so out, that figure? 120,000 less than we had. Can you explain it?
Well, without getting too personal opinions involved, the government is not always the best at what it does. And so here's the thing. What's kind of interesting here is that, admittedly, it's a very hard number to really track. Like, there's so many people, there's so much operations going on. And we've seen this over the course of, many years now. Revisions oftentimes are volatile. And, it is kind of baffling, and I don't claim to have the full answer or explanation as to why, other than there's a lot of data that comes in late. There's a lot of miscalculations. There's a lot of any sort of error. But I would agree with you. It's kind of it's kind of crazy to think that 120,000 jobs just went missing or came up and then went missing again. So I don't know the exact answer, and there's probably smarter people out there who could give a more comprehensive answer. But what I do think, as for market participants, you have to be very aware of revisions, and a lot of times everyone covers the headlines and revisions don't get enough attention. But a job is a job, and a job lost is a job lost. It still matters, even though it's been a month since they initially reported it.
Markets seem to be favoring chances of a May rate cut now, particularly after these figures today. What are the percentages where you are, and what is the more likely? Is it May or June?
So right now, if we can use just the CME Group's FedWatch tool as a basis, it's saying about a 26% chance at the time of recording this podcast that we could see our first rate cut in May. Now, that might not sound very probable, but remember, a couple weeks ago, we were thinking July or even September might be our first rate cut. So we've pulled forward pretty dramatically. Now, when we switch over to June, I'm looking at June's probabilities, and now we jump up to, okay, we're looking at a 60% chance that we'll see our first rate cut in June, according to what market participants are thinking. But maybe more importantly, almost an 80% chance, according to, again, the watch tool here, that we'll see our first rate cut by June. That could be in May or by June. So really interesting. You're really seeing those probabilities pull forward. And I got to say, Johnny, for a little bit, it looked like we were just getting hot data after hot data in the US. It looked like everything could not be beat. We had that jobs data. And so, it is a bit frustrating also to see those huge revisions. How could we have gotten it so wrong? And there was this kind of fake out in economic data that seems to be materializing. But as you mentioned earlier, jobs are just huge. It's such a key and core component to the Fed's mandate, right? It's one of two. We always talk about this. They want 2% inflation. They want jobs to stay steady. I think if you get over 4% in terms of unemployment, and by the way, we're at 3.9, if we hit over 4%, that's going to throw up a lot of red flags, and I think rate cuts will be way more pressing from there.
CPI is an important figure in terms of any predictions for interest rate cuts. We've got some CPI next week. With that, what other highlights should we look ahead to in the next few days?
No, I think you hit the nail on the head there, Johnny. I mean, we have Tuesday's CPI number coming out. And again, going back to the dual mandate, it is jobs and it is inflation. And now that we're seeing jobs data slide a little bit here, I'll give a fair warning to people who are listening, who are watching, the dollar, or you're watching commodities or indices. Here's something to be cautious about. If you get inflation staying sticky from here, now I think the market could actually see a little bit of a freak out, because if you get jobs data and economic data kind of showing slowdown, but inflation's not moving down lower, now we have a serious issue. Because what happens in that scenario is I don't necessarily think that this is the base case or what is likely to happen, but that starts bringing in, you probably hear the headlines of all the different outlets start talking about this idea of stagflation, which is where you have stubborn inflation and stagnation in growth. And if you get that scenario, those are the scenarios where we've talked about on the podcast many times. That's the gold, kind of rally sort of environment where growth is really slow and inflation's a problem, and people start getting really concerned about whether or not, hey, can the Fed actually pull off this soft landing idea? Is that getting called into question? So I think that in terms of recent developments, you pointed out Tuesday's CPI number. That might be single-handedly might be one of the most important figures to come any time in the future for now. Jobs data was huge today. It really was like the first part of calling this whole thing into serious question. CPI will either revert that if you get an okay number, if you get inflation coming down, then hey, we might be still fine. But if that inflation number is hot or stubborn and not coming down, it would mark a couple months here where we have not seen meaningful inflation coming down. And I would say that at that point, you might start to see some more risk off movements in the market.